Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today's Thursday. It's December 15th. I think we're like a week away from Christmas. I can't believe the December is coming to an end. Holiday season's here. Yesterday, actually, December 14th, is the official day that holiday shopping season really heats up. And when I say really heats up, I mean like gets hot. So you may start seeing a little disjointment in market, people's behavior, people being a little bit late, people not focused, driving a little weird. For the next week, you're going to see a lot of that. So again, right now we're in the biggest part of the holiday shopping season. Started yesterday. I actually didn't know that. I thought it would start like the 10th or 11th, but it actually starts on the 14th. Now, getting into the market, and I do want to talk a little bit about this, but I also wanted to pull up this report because we do have a lot of data coming in today. But as you could see, the Dow is down 339 points. And if you look at the Dow Jones, and folks, for anybody who's sitting in going, Roger, what happened? The market was bullish. We thought the bulls were taking charge. What did I tell you? I told you it was a false breakout. We're now trading below the 8-day moving average. Let me go ahead and move that back to 50-day moving average. But the point of the matter is we are headed down. And if you look at the SPY, I just want you guys to see this. We're not doing all that great. We're below the 200-day moving average, headed down. And as soon as we break this level right here, and that's actually something I want to talk to you guys about. As soon as we break this level right here, right there, and that happens to be right at 39,000. We're now at 39,500. If we break this level right here, which is at 39,000 or 390 on the SPY, sorry, not 39,000. I'm looking at the Dow. 3,900 on the SPY, on the S&P 500, or 390 on the SPY, which is what we're looking at. Just to be clear, want to make sure we're clear. SPY, the S&P 500, the big one, 3,900. SPY, the SPY ETF, 390 right here, this little red line right here. Once we break through this, there's really nothing holding us back down, and we're going to come back down. And in my opinion, we're going to come back down all the way to the base. And I've been saying this entire period right here. I said this rally will not hold. Now, I know it's holding on longer than we expected. And the bulls did absolutely everything humanly possible to bring us to trick us into thinking that the markets are going higher. I mean, everything. I mean, look at this. The Dow starts breaking out. It starts moving higher. 1,000 points up before the open just to come back down. And where do we end up? Where we were before the news announced. And what do we have now as a major catalyst? Zip. Fed saying that interest rates are going to stay higher for at least as long as we thought. Maybe not 0.75, maybe not 0.50, but they're not going down. They're going higher. And if you look at the bond market, you will see that only closed up 0.4 yesterday. We're also sitting right here, and we're already down 0.71 for the day. And as soon as we break the 105.50 level on the TLT ETF, this sucker is going to go down back to the base. Now, we've got a lot of data today. Jobless claims, manufacturing index, retail sales, which is a huge report, industrial production. So let's talk a little bit about all of that stuff and the Fed. And then I'll get into the nitty gritty. And by the way, folks, I haven't been seeing a lot of comments in the video section in YouTube. Post comments, ask me questions. I will respond. I want to see your questions in the YouTube Wealth Press channel. Please, it'll make my day. And if you have questions, email me, support@marketgeeks.com. And please like and subscribe to this channel. Let's continue. Now, Federal Reserve moved to expected slower pace of rate hikes, but signaled higher rates for a long period. Folks, there's no bull market in sight that's going to go with an inflationary pressure that's going to go higher. It just doesn't work that way. That's just against economic principles. Federal Reserve hiked interest rates by 0.5 basis point on Wednesday, marking a slowdown from 0.75, seen in the prior 4 meetings. Also, the Fed projected at least an additional 0.75 increase in borrowing costs by the end of 2023, at least, as well as a rise in unemployment and near stalling economic growth. That's not a bull market, folks. I'm telling you. Earnings revisions are not expected to pick up for 2 quarters. At the same time, the central bank lifted its projections from the benchmark rate to peak at 5.1% and remain at that level through 2023, up from 4.6. Not great. Not great at all, and not working nearly as fast as investors and traders thought. U.S. core retail sales data will come out today. I'm looking at it very, very closely. They're expecting the figure to be up to 0.2% month over month versus 1.3% month over month. U.S. industrial production data will be reported today. Economists foresee it standing at 0.1% positive compared to 0.1% negative. And then we've got jobless claims. I think the number is going to be right around 200, 250, somewhere in between. Honestly, that number has been fairly steady. And as long as we're by the moving average, the 4-week moving average, which is like 220, 225. Let's see here. I think the moving average is right around 220,000. We'll find out in a second. But let's continue this. Europe. Today, investors globally are focused on interest rate decisions from Bank of England and European central banks, which are going to impact U.S. markets too. In addition, Swiss National Bank hiked the key policy by 50 basis points to 1%. Finally, positive interest rates. Be still my heart. Shanghai closed lower, tracking significantly weaker than expected industrial production and retail sales. China November industrial production stood at positive 2.2% for the year, weaker than 3.6%. That's 50% weaker. And rising COVID-19 cases increased curb weights heavily on the second largest economy. Japan closed lower as the country logged larger than expected trade deficit in November. Now, earnings came out yesterday on Novavax and Leonard Homes. Both stocks dropped. Not good. Those were the big ones. Western Digital also came out. The numbers were soft. Today, you're going to see numbers from Adobe and JBL, Jabil Circuits. It'll be very interesting to see, but those are the only really big stocks. Now, Adobe's a big stock, so that will be very, very interesting to see. Now, looking at the jobless claims, here we go, the moving average. Here, 4-week moving average, 230,000. So even if it's 235, if it's a 220, this hasn't really been off the charts. Again, you got to keep your eye on the Treasury notes today, and we're looking at the 11 sectors. Now, things are starting to cool off a little bit, and this excitement that the market had is now starting to subside because there's no major catalyst. Investors thought that was it. The Fed is going to scale back interest rates. What they're doing is working. It's working. No. We're still deep in this, folks. We're going to be in this mess for at least another 6 months. So, healthcare, industrial, look at consumer staples. Remember, it went all the way down and it came right back up. There you go. Basic materials, energy starting to come up. Technology, forget about it. Utilities, I still like. But focus on what's in front of you right now. Focus on healthcare. Focus on consumer staples. Industrial and basic materials, you got to be very cautious. That could work for you or against it. It depends if it's industrial, like Lockheed Martin is industrial. Military, defense stocks, anything material for defense, basic materials relating to consumer staples and commodities will work, but some materials will not. But healthcare, consumer staples are definitely where you want to be right now. Now, just to give you some ideas of what's happening right now, momentum levels to the downside have not began picking up yet. We only have 71 stocks making 20-day breakouts and 20 stocks making and 116 making 20-day breakouts. That's because the market is still coming off of that sugar high from the anticipation that the market was going to just go bullish. We took out the high here, but look at what happened intraday. We went up, opened high, real close to this, and then just came right back down. Suckered investors in and went down again, and now we're lower. And I'm telling you, as I sit here right now, this is not a market that's ready to go higher. This is a market that's trying to fool everybody and their mother that it's ready to go higher, but it's not. It's ready to go lower. And so is the bond market. Now, folks, I want to show you this. If you look at momentum levels, and we've been going through this every day, look at the NASDAQ right now. 53% of stocks are trading above the 50-day moving average. NASDAQ Composite, 45%, and only 57 are trading above the 200-day moving average. So you got the S&P 500 last week with 90% of stocks trading. Now it's at 79%. Look at how it's coming off, just as I expected it to. Look, coming right off right here. Let me just decrease these levels right here. Coming right off, coming down. Meanwhile, the NASDAQ composite, only 57% are above the 50-day moving average, and 45 are up. And on the Russell, 40%, 50%. Folks, it's coming down, and what you're going to see here is you're going to see energy increase momentum in the short term. You're going to see a decline in the 50-day, that the 50 days are all going to look very similar to this, and you're going to see a lot more red here. That I can almost guarantee you. Look, Infotech, 51%, material, 50%. The colors are turning in front of our face. So be very, 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 very cautious. Now, if I were you right now, and if I was looking at ETFs, and remember, today's Thursday, and we focus on ETFs on Thursday, what I would be focusing on right now, let me show you, is the healthcare or consumer staples. I like healthcare right now. So let me give you a good ETF and an option pick with healthcare. Here's the XLV. I like where it is right now. Maybe give it another day or two to cool off with the rest of the market. It's already down one pre-market. I would go to right here, 92 days left. Perfect. It's 140 right now. You can get yourself a 142 for like $4, or you could do the 143 for $4. They're not that expensive. 420, 360 right here. They've got plenty of open interest. Liquidity will be fine as the market continues today. Implied volatility is not all that high, but I would go with the March. 142 to 144, somewhere in that ballpark. If you're going to do a spread, which I really don't recommend, but if you will, do the 142 versus the don't do it. If you're going to do it, do 140s versus 145s. That's a good spread right there. But honestly, I wouldn't even spread it. I would just buy the 143 and call it a day. And I think you're going to see upside, but you may want to wait because this sector looks like it's going to cool off before going higher. Now, before I let you all go, I hate to say I told you so, but I did. Folks, I have to be honest with you. This market looks unstable right now. I'm seeing a lot more short opportunities than long opportunities. Now, I know. I sound like a broken record. I've been telling you guys that throughout this, but look at where we're at right now. And if we break a little lower, we're already down 310.91 for the day. We're going to go down. So 335 is, or 335, 334 is that level on the Dow. The Dow breakdown level is 33,460. Okay? Or if you're looking at the DIA, it's right at the 334 level. Now, folks, before I let you go, ask any trader when the market's open, they'll tell you 9:30 Eastern time. And that's true. But the problem is, it's not the whole truth. Market action starts long before 9:30, which is why I do these videos long before the market opens. And that's when most professional traders position themselves for the best opportunities long before most investors even sit down at their desk. Notice when I do these videos, I'm kind of creating a game plan for what happens when the market's opening, and I'm using overnight data. It's exactly what I do in these morning videos every day, an hour, 2 hours, sometimes half an hour, 45 minutes before the opening bell. Now, there's a reason I recorded this video, my morning outlook, before the market opened. And that's when I do my analysis. During market hours, I don't analyze anything. My analysis is done pre-opening bell. So I'm joining forces with T-Buzz, Tom Busby, to show you a little known but powerful, very powerful pre-market strategy. It's happening at 1 p.m. Eastern time today. Reserve your spot at no cost. Click the link below. Don't hesitate. Join us today and discover how you can gain an instant edge compared to other traders. And folks, again, notice when I do my analysis before the open, notice I'm looking at international markets, I'm looking at pre-opening prices, I'm looking at the futures. It's all happening before the opening bell. I decide what we're going to do before the opening bell, just like I do in these videos. So T-Buzz, I call him T-Buzz, but you may know him as Tom Busby, and we do these morning videos so that we do these morning analysis pre-open. That's how we analyze the markets. So we thought we'd get together and teach you and show you and give you some really cool tricks and tips and techniques and morning outlook and a good roadmap to help you gauge the market. You really need to see this. T-Buzz and I haven't done anything in a while. It'll be a lot of fun. I'm looking forward to it. I got my colorful t-shirt on. I know he likes the colorful stuff. So we'll have a great day. It's coming today at 1 p.m. Eastern time. Follow the link below. If you're watching on YouTube, follow the link in the YouTube channel under the Wealth Press videos. I'll see you there. Send me an email, post comments, and be careful. This market is dangerous right now. Bye, guys.